Welcome to StockCharts TV 2021 Market Review Power Charting Edition. I am your host, Bruce Fraser. Welcome. Disclaimer, please take a look at that. This is our agenda for this very brief session. I'm going to cover a lot of ground and do it in a short period of time. We are going to talk about the relationship of the US dollar and bonds, the secular trend of interest rates and inflation, high yield bond trouble, commodity trends in 2021 and the outlook for bonds and the dollar with an interest rate projection. Now, the reason I'm doing that is I'm going to try to pull all this stuff together into a cohesive whole for you. And these charts, many of them you have seen throughout the year. And so let's get going. This is a very long-term chart back to 2012 of the US Treasury bond index. This is prices. Remember, when prices rise, interest rates are falling. This is the dollar index. Roughly speaking, the yellow shaded area represents when the dollar is falling. And also you can see that interest rates or the bond market is falling, interest rates are rising. Tends to be somewhat of a negative environment for the bond market. So the blue area, rising dollar, rising bond prices, falling interest rates. Here's a very long period of rising bond prices, rising dollar, falling interest rates. And then here you can see starting in 2020, a decline in the dollar and a decline in bonds. Well, look what's happening now. This is what's most important, is notice that both of these are rising. So keep that in mind as we go forward. Here is CRB. Now we're going to correlate the idea of inflation and interest rates. Inflation rises, interest rates rise. That's the normal relationship. Inflation drops, interest rates drop. We're looking at CRB as a major component of a basket of commodities that influence the price of goods and services and either cause inflation to expand or decline. You can see here, this is going back, this index goes back to 56. Here you can see that interest rates, or in this case, this is CRB, is rising throughout this whole period at a very rapid clip. And many of you remember, us senior folk, remember that interest rates went up dramatically during that same period. Since then, we have been in a secular decline for interest rates. They've gone down, down, down. Well, here you can see starting in the early 80s, the CRB was grinding down for a number of years. And then in 2000, 2001, made a low and started to go up. So we had CRB, basket of commodities, rising. Well, look at this interesting thing that happened. Interest rates went up a little, but they stayed low. The secular trend continued to decline. Fascinating. So I think that the Fed had their finger on the scale through that whole period. And now you see that CRB has fallen quite dramatically into the COVID early 2020 low, and then had a very sharp spike. Well, is this sharp spike going to lead to higher interest rates? Well, look here, we can see there's really been no jump in interest rates. Again, the Fed has had their finger on the scale. So US 20-year Treasury bonds This is the price of bonds, which during this period, now this goes all the way back to 2003. You can see this is a rising trend, and it continues to be in a rising trend for bond prices and has been consolidating through this whole area here. Well, I am here to tell you that if we see Treasury bond prices, as measured in this case by the TLT, fall through this trend line, I would start to really worry about interest rates rising, falling bond prices, rising interest rates. Right now, we do not have that. They continue to be up in this trading range area. I expect that to continue. I put a count here, but I don't think this comes into play until we break this trend line. Now, this is a little shifting gears. Here is the high yield bond market. High yield bond market is highly sensitive to the economy. And so here we had a large base build that many of you have seen this chart. We've had a count up to this area here, 3192, 3382, and then a reconfirming count here. And in fact, we went right up to that area, 3280. And what happened next? Well, looking at the chart on the right, you'll see that high yield bonds built the top and now they're falling. Now, that means that yields are rising, interest rates are rising for high yield. I think that's more related to the economy than it is to the pure bond market. I don't know that this is an effect on treasuries. Here, this is CRB. This chart I've shown many times. This is my count. This chart I made back at December 31st of 2020. And you can see there, this is the count here. And and this is through the end of 2020. And you can see a large count built during the year in 2020, and this was the count objective. Well, this count objective was fulfilled and made its final high October 26 at 241.18. So it got into the middle of the range here of the larger count and has topped out. Here is subsequently what happened through the end of November. This is CRB on the left. CRB has fallen out of its uptrending channel. I had built a count here, and this count took us up to 249. We got as high as 241 into the range of the count, could not get to the top, and then this decline happened. I think this means that CRB is at best range bound and possibly could decline for a period of time in 2022. This could be good for interest rates. That's the conclusion that I want to draw here. So here is crude oil. I'm not going to spend any time on it other than to say that it became overbought up here in 2020. I had a count in crude oil, big component of crude oil in the CRB, by the way. So they are related to each other. I had a count 85.12 up to 112. And we got up to 85.44, just above the lower estimate here. And that is as far as we've gotten. And you can see since then, crude oil has been somewhat weak. Again, I think crude oil is range bound, potentially in a trading range for some extended period of time. I think both of these conditions are going to have a moderating effect on the concerns about inflation going into 2022. Whether inflation heats back up later in the year is anybody's guess at this point, but we'll keep an eye on these indicators to give us advance warning about that. But I think that inflation and the inflation rhetoric is going to calm down some as we go into 2022. What effect does that have on the US dollar and on interest rates or the bond market? Well, I've done a point and figure chart here for you. And this point and figure chart is through the 8th of December. And you can see here, there's a beautiful little base. Now, this is just a one box reversal method. So this is looking at swing trading counts. So this is the beginning of 2020. So substantial period of time. This count here was a very wide structure, built a wide count, but the lower edge of the count went right down into the midpoint of this new range, which looks like reaccumulation. It's already climbed up and out and has built two counts that I've taken here. And this count is 2620 to 2680. The higher count goes all the way to 2760. So that suggests that UUP, or the dollar, and this is a proxy for the dollar, is saying that the dollar index could be rising in 2022. Recall from our early chart that a rising dollar tends to support rising bond prices, falling interest rates. And so this could be a good backdrop for the bond market. Here is 7 to 10 year US Treasury note ETF, symbol is IEF. And here you can see there's a really nice little count back here. This is again, this is a 3-box reversal method. So, and this count here gives us a count objective all the way up to 120.20, 121.20, which is above this prior peak right here, which is July, August of the year. And so this suggests that we could have a count that takes us to higher bond prices, lower interest rates as we go into 2022. And this is against the backdrop for tremendous concern about budgets, about inflation trends, and so on. And the bond market seems to be telling potentially a different tale here. Here is the 30-year US Treasury bond yield chart. So this is yields. So falling yields, rising yields. And here you can see that there's a trading range structure that's been building since July. And this interest rate trend has fallen below the lows of the July low. So recently interest rates have been falling, and here in the very short term, they've risen a little bit. Well, this looks to me like it could be a structure for, in this case, redistribution or further falling interest rates. Very important. And so you can see here that this is got to turn back down here in the very short order and go back below this low, the selling climax. And so we will watch for that. So a rally back up in, and then we will look to see whether or not the trend can continue downward or not. It may not. But at this point, it's a very interesting place on the chart. And finally, I want to show you the 10-year US Treasury yield as a point and figure chart. And so this area here represents this most recent structure. And this is a count that I've taken, which gives us an objective for lower yields. So down here where it says 11.00, that's 1.1%. So they just multiply by 10 for the sake of plotting the point and figure. And here you can see this count across this area worked beautifully and took us back down to 1.1% again. And here we have another count and also a lower high in yields through here. And so we will watch to see whether or not, again, on the chart we just saw before, which is a chart of this is the 30-year, but it's the same effective phenomenon. And here we're looking at the point and figure of 10-year yields, and we will watch to see whether or not they can continue their decline and get into the range of this area here. And after that, we'll have to see what happens just as a small base build for higher yields into this area. We'll see whether or not this can happen if we can get down to this level. And so here we are, we've done it. This is sort of my outlook for the 2022, at least as the year starts. I think there's potential for falling interest rates. This would be a great backdrop for the stock market. And also, I think it really indicates that the whole issue with inflation, even though it could be a long-term rising effect, is for the time being going to moderate as we go into the first part of 2022. And this also could help the stock market also. And with that, I'll say thank you for attending. Watch Power Charting Friday afternoons, 3 o'clock Eastern time. And thanks for being here.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.